So I'll follow up with her again in a couple more weeks. But I think the lines of communication are open, but we haven't gotten any money yet. That's where we're at.
So we haven't gotten any money at all, or they just missed a check? Sorry.
We haven't gotten royalties for probably 18 months.
Okay.
Yeah. There was one check that came in, but they're going to true that all up, and we'll get them and make sure that they seem reasonable once they get things all accounted for.
And those are the pumps by Monroe?
Yeah, they're on in the industrial park,
Yeah.
one on Drive.
Okay.
Is it expected, Ed, to be a substantial sum, or?
Oh, it'll be tens of thousands of dollars.
Okay.
Maybe as much as 40 or 50 potentially.
Okay.
Should be.
Okay.
Be great if we see it.
Yep.
Any questions for Ed on this? Are we? All right, moving on. New business, approval of minutes from May 2nd, 2022.
I'll make a motion to approve the minutes as presented.
Support?
Thank you. Should we just go all in favor, say aye? All in favor, say aye.
Aye.
Opposed, nobody. Okay. Investment advisor update and commentary. I guess I'll turn it over to Woody. Right.
Thank you, Mayor.
Yeah.
I've got Troy Snyder and Brian Walker on the call. Troy and Brian, can you hear us so far?
Yeah, very, very good, Woody.
Okay, good. So let's turn to tab 1. And here we, as you may know from prior meetings, we talk about the market conditions, the economy, capital markets, that kind of thing. And we have on page 4, the Bartlett's market assessment, we have some positives and negatives. And I'll just maybe make a few overarching comments, and then Troy and Brian may chime in with some of the charts behind. But I think what's interesting about this market that we've had for the last 2.5 years or so is that it's extremely unusual when you have the market, all segments of the capital markets, stocks, bonds, commodities, and real estate, go up and then go down together. And that's what we've had. This is something that would be, I don't know, some of you may remember Six Sigma, which is 1 out of 1,000. This is not quite that, but it's in the 1 or 2% of market cycles where you have everything going up and everything going down. Now we maybe, since the market's somewhat recovered in the last 6 weeks or so, we've started to have more separation where maybe real estate is not going up with stocks or bonds. There's some kind of non-correlating activity. But part of this is because the Federal Reserve has been so active. They are such a dominant force in the markets in terms of money supply, interest rates, and they will drive a lot of this, these markets all working together in tandem. And that's now changed because for the first time in over 40 years, where the Federal Reserve, prior to the last 40 years, they took preemptive action, which means if they started to think interest rates or inflation was going up, they would start to slowly raise interest rates. They have not done that. They've been sort of aggressively pushing and pushing with stimulating the economy, and then all of a sudden, they're facing the consequences now, which is inflation. And prior to that, the Federal Reserve was always more tapping on the brakes long before you started to get inflation, because you just knew that when you inflated and you lowered interest rates, things would happen. So it's been an unusual economy in terms of everything going up and then down together, and it's primarily because the Federal Reserve has been overly aggressive where they should have maybe slowed some of their stimulus activity down maybe a year or two ago. If you look on the next page, the dominant factor that's driving the markets today is inflation. This is what, month to month, as the government releases inflation data, that is what is going to drive volatility in the market for now and probably for the near future. And what's interesting about this chart is the green bar, you can see month to month, we're seeing inflation, up close to 9%, 8.5, 8.6, 9. We have some data that doesn't show here, 9.1 in June, Now it came down a little below 9 in July. But the long-term expectation of the markets is still to keep it roughly around 2.5%. The markets, there are financial instruments that gauge what the big smart money is thinking, and the big smart money is still expecting inflation to be about roughly 2.5% for the next 10 years. So at some point, what the market is saying is that this spike in inflation up to 7, 8, 9% is going to be coming down next year, and whether it comes down to under 5 or under 4 or under 3, we don't know, but averaging out over the next 10 years, there's still a fairly optimistic outlook for keeping inflation under control. And that's probably why we've seen the market respond so favorably in the last 6 weeks, because we're starting to see evidence that maybe this is actually going to happen. It's too early to declare any victory, but it looks pretty positive that there's sort of a rolling over of inflation. I think there's a few other charts in here. We don't need to talk about all of them, but I think I'll maybe hit one high point, which is how does Bartlett allocate the oil and gas portfolio today in line with your policy? And we're sticking to the policy targets today because we feel there's enough optimism. There's a lot of mixed signals in the market, but there's enough reasonable optimism in conjunction with stocks being reasonably valued that would keep us pretty much at your target of about 65% in stocks. And that reasonableness is probably best seen on page 7, where you see valuations down to long-term average. This is going back about 60 plus years as to what the price earnings ratio on the Standard & Poor's 500 has been. And the price earnings ratio, you may have heard us talk about that in the past. If there was one indicator that best represented the reasonableness of stock prices, it would be the price earnings ratio. And that effectively, when you think about this chart, is if you took the market value of all the stocks in the Standard & Poor's 500 and divided that huge number by all of the net profits of the Standard & Poor's 500 over a 12-month period, you get a ratio. And obviously, when that ratio is very high, it's telling you that stocks are highly valued. They're high in relation to the profits. And when it's low, presumably the market is a good value because you're buying a lot of profits for a low multiple. And you can see, over our lifetime, most of you guys are pretty young here, so it's
Thank you, but
nobody's.
I don't know.
I'm on the chart.
No, okay.
In fact, I'm off with one.
You're off the chart.
I'm with Doug.
So you can see that, back in like the year 2000, when we had that kind of bubble market, that ratio got very, very high. And then back in the late 70s, it got very, very low when inflation was very high. But right now, we're kind of at the middle. So probably not a time to take a big bet that the market's going up or down. If you wanted to use this as a chart as an indicator, which we only use this in a minor way. With that, I'll turn it over to Troy or Brian if you guys wanted to comment on any of the other pages in this first section.
Thanks, Woody. I'll just mention the environment for investing in bonds has improved materially since we spoke maybe a year ago, when back then interest rates were really close to 0 up to maybe 2%. Today we can buy bonds between 2% out to 4%. So may not sound like a lot when you compare that to what you get in stocks over the long haul, but as of the balancing part of the portfolio, the shock stabilizer, bonds, offer a lot more steady income now than they had in the past. So that's the bright side. They've had a tough year, and I know Woody mentioned this. It's unusual that bonds and stocks would perform together in this kind of a year. Normally, when stocks have a negative year, bonds are the hero, and they do a little better. That hasn't happened quite yet, but it's things are starting to turn a little bit here as inflation maybe has peaked and it's still too high, but it has helped. We're going to review performance through June, But I'll say July was very good for both bonds and stocks. And so when we get to the performance numbers, we'll talk a little bit about that. But yeah, it's just, the Fed has got a good fight on their hands here with inflation. They learned from the 1970s and early 80s when inflation was last such a problem that you shouldn't take your foot off the brakes so fast. What we learned back in the 70s was every time you gave up on inflation, thought it had rolled over and was coming down, it would spike back up. So I think that's what we're hearing from the Fed a little bit here is just because inflation's starting to roll over, they're not going to necessarily stop raising interest rates. So we'll continue to see more hikes in the balance of this year. The expectations, how high will they raise rates? The thinking there is between 3.5% and 4% before this is over. Inflation's running, as Woody said, over 8%. So somewhere those two numbers need to come together. Inflation needs to come down. Interest rates are going up. Once interest rates are running higher than the level of inflation, that's been historically the point where the Fed takes their foot off the pedal and stops raising interest rates, and generally we go into a period of stability, and if not, interest rates will be declining. So very interesting times, and I know you all see it up there in the higher cost of everything we're buying right now, and I guess the good news is at some point that's got to roll over, or else it's just going to get really bad. So it's good to see that this most recent number was leveled off and fell a bit.
If we had put
Brian, any thoughts on it?
Sorry, I have
Yeah.
a question. If we had put the brakes on sooner, like raising the interest rates gradually, at least a year before we just actually started to put the brakes on it, would that have helped level things out, inflation-wise, do you think?
Yeah, I think it would have helped, but not entirely because of the supply issues and what's been going on in the energy markets. Those are two sort of coincidental issues going on that kind of contributed to this great rise in inflation. During the pandemic, which was obviously an extraordinary event, the Fed and the Treasury pumped a ton of money into the economy, just a phenomenal amount of money supply. And we're going to be working that off, and that's going to obviously help over time. But that's really kind of what we're working through here is just that extraordinary stimulus that no other country in the world put as much stimulus into the economy, the global economy, as did the U.S. So we're seeing that come back as some of the higher inflation rates of the developed world.
Thank you.
I'll just add, a lot of other countries are experiencing inflation just like we are in the U.S. And even though they didn't have the amount of monetary and fiscal stimulus that we have, they have the same pressures on their supply chains, mostly due to COVID and obviously also energy prices that's set globally. So, they're experiencing the same issues that we are here. And their central banks are all tightening conditions as well. So it is a global phenomenon.
Yeah.
I think another page here that Brian was involved in putting together is page 9, and this really speaks to the oil and gas portfolio, which is traditionally a 60-40 portfolio, and yours is 65% stocks, 35% fixed income. These kind of portfolios, the bonds act as a buffer, and they cushion when stocks go down, typically bonds go up. That's why we have a balanced portfolio. And you can see over the last 45 years, other than 2008, which was kind of a very unusual time, interest rates, it wasn't that interest rates went up, it was more that with the financial crisis, people were concerned about whether companies were able to repay the principal. And so a lot of the bond values went down. That was kind of a very unusual situation. But you can see that what we've had here, we've had a 10.8% loss year to date on a balanced portfolio, a 60-40 portfolio, which is very unusual. going back, over that period of time. That speaks to everything going up and everything going down together, which is unusual. Any other questions on this section? Tab 2, you can see a snapshot here, the asset allocation page, page 11. You can see where we are as of the end of June, about $12 million for the portfolio. That includes the internal loan and cash on hand in Manistee. And in July, we had I think that distribution has already been made, Ed.
It went out in July.
Yeah, and that was 4?
Close to, 400.
Yeah. So we had, that came out, and yet in spite of that, we've had quite a rebound in the market. So in spite of 400 coming out, today the portfolio is probably getting close to about 12.4. So that's kind of about an $800,000 bump that we've had since the end of June. So you can see we're pretty close to the targets. The target allocations on the far right-hand column, that's from your investment policy statement. We have some international equities. The good news, as you'll see from the performance page, is, since we've been managing the portfolio, international equities have been kind of an abysmal performer. And it's good that we have a very modest allocation there. Some funds like yours will have as much as 30 or 40% in foreign, but we've kept it pretty slim, I think around 15% or so.
Do you anticipate that changing at all, Woody?
Probably not much. The policy is 65% in equities, of which 10% is foreign.
Okay.
So what is that, about 15% of the total equities?
Yeah, so not really.
That's kind of, as you know, it's probably a little bit on the low side for institutional portfolios, but some might be 0, which is more unusual, and some might be 30. We're probably kind of in the middle, but the middle is pretty big. There's a wide range in the middle.
Yeah.
And I think when we started back in 2009, that seemed reasonable, but whoever would have thought for 13 years that international was just flat.
Yeah. And the only reason I ask is, just because you've had such the appreciation in the dollar, and so I just wonder if that plays into any kind of thinking in the long run on the international side, because, who knows, right? Like, not in the business of predicting, but if the dollar does come back down to more normal levels, I'm not telling you anything you don't know. So.
The argument, the valuation argument is strong in that I think Brian has the data, but I think the dividend yield on the foreign stocks might be double what ours is in this country. And going back to that price earnings ratio, it might be maybe 2/3 of what. So in terms of getting a good value or a bargain, you would think international is better. But we also read the paper and we know what a mess foreign governments are. They
have coming up.
They don't tend to be as capitalistic. They tend, there's socialist things going on. There's a lot of political obstacles to being pro-business. And there's things like wars, countries invading ones next to you, and, some other things that are kind of an overhang. I don't know, Brian, did you have any further thoughts on that?
Yeah, you touched on the dividends. The dividends for developed international are about 2.9% annually. In the U.S., it's about 1.7%. So the dividends are more attractive. This year, we've had the last few years, is the earnings growth internationally has not been nearly as strong as it has been in the U.S. So even though you're paying less from a price earnings multiple, like we talked about earlier for international stocks, that's maybe more like 13 times, where the U.S. is around 15.5 or 16. You are paying less, but there's also less earnings growth there. And I think the outlook is very dim in the near term, at least in Europe, with the Russia-Ukraine situation, and they're much more impacted by the energy crisis there than we are.
Woody, have semiconductor stocks reacted at all to the money that's going to be flowing their way from the latest splurge of federal cash?
Well, the problem, it's kind of hard to discern that, Ed, because it's a very weak market. All of a sudden we went from like a shortage of semiconductors to now there's a surplus, and the market has been weak. And so whether this stimulus of the industry is good, it's being more colored by the weakness in the market for semiconductors. So, the balance of those two is the market for those companies has not been very good recently. I think companies like NVIDIA, Intel, Advanced Micro Devices, Micron, these are all the big players in that area, and then Taiwan Semiconductor. They've all been pretty weak, and it's more because there's just sort of a softening of demand. Brian, did you have any other further thoughts on that?
It was a little hard to hear the question.
The question was whether, well, I think we can move on.
Yeah, it's fine.
I think that was, Troy, did you want to pick up on page 12?
Yeah. So page 12 is a snapshot of the portfolio as of June 30. It really hasn't changed a lot since then, but this looks at the portfolio characteristics of the bonds in the portfolio. The table in the upper right shows that some of the key metrics. Average maturity for the Manistee portfolios, about 4.5 years. The duration, which is an interest rate sensitivity, also about 4. The yield, 3.13. Again, that's up pretty significantly over the last couple of years. The average credit quality is A+. And then you can see a couple representative bond benchmarks there to the right of that column. The Barclays Government Credit Intermediate, and then the Barclays Intermediate Credit, which is 100% corporate bonds. You can see what those metrics are, very similar. A little bit more yield there on the all credit benchmark, but that also holds more lower quality bonds than would be put in the portfolio here. To the left, you've got the maturity distribution. The Manistee portfolio is in the green. Pretty well positioned across the maturities with an emphasis on bonds in the 1 to 5 year, really. Got good maturities coming up that will help us continue to increase the yield on the portfolio as those bonds are reinvested. To the lower left, at the bottom there, you'll see the different sectors that the corporate bonds or that the bonds are diversified into. You've got treasury notes, agency notes, mortgage-backed securities, and corporate bonds, with corporate bonds making up one of the bigger sectors of the holdings. To the right, lower right there, you'll see the credit quality distribution, and the Manistee portfolio is very high grade. It's got mostly A and AA bonds when you're talking about the corporates, but some BBB bonds. And then the treasuries and the mortgages are the higher quality in the AAA range, with the backing of the U.S. government for most of those. So high grade, high quality, and well diversified. The portfolio's structured to deliver, very reliable income over the next many years. So looking forward to continue to get that yield higher as we've got more to work with now, and we'll see what the Fed gives us here as the rest of the year works its way through.
Troy,
any questions on the bonds?
Troy, this is Ed. What is our cash yielding at Schwab right now, roughly? Do you have any idea?
The cash yield, I think it's about 1.6.
I think it might be 2.1, I think, in that, if it's in the SWVXX.
This SNVXX, that's up to about 2.1%.
Okay.
Oh, it's moved up.
Haven't seen that in a while.
It moved up pretty significantly right after the last Fed increase.
Yeah. So it's good point, Ed. It's nice to have some yield on cash once again.
So with the, Troy, with the bond, this is Jeff, with the bonds maturing, do we try and stay with the 4-year duration? Will we be looking at that 5 to 10 year, or will we go longer?
We, our approach is to have a balanced portfolio even within the bond mix.
Yep.
So when we have cash to put to work in the bond portfolio, we look to see where maybe things have changed and where it needs the new investment to land. We're not opposed to buying 10-year bonds right now. I think even though rates have been going up and they could go up a little higher, the yields out there can be a little better. So, we look across the board at the best opportunity. What we don't want to do is inadvertently have too many 10-year bonds and wind up, with interest rates going up and, you have a little bad experience on performance. So we're always trying to kind of not go overboard with where the best yield is. It can kind of be deceiving, and suddenly then you've got an unexpected outcome in the performance.
Right. Just, only reason I was asking, because it just looks like as the maturities go, the 5 to 7 looks like something that we'd probably be adding more to as things mature, because just to kind of keep with that target, right?
I'm not hearing completely your comment. Woody, could you repeat a little bit of that?
Well, he was, I think, asking about, it looks like given rates have gone up, would you consider raising more of the allocation in that 5 to 7 year range?
Yeah. Yeah, I mean, we definitely, you can see that we have an overweight in the 3 to 5. And so as the bonds shorten, as the portfolio needs more duration, and duration means buying longer bonds, we'll absolutely look at that 5 to 7 year and that 7 to 10 year for, an opportunity to lock in better yields. That's exactly the way we would do it.
Troy, it looks like you've got a lot in that short, but that was, I think, before the cash went out for the capital budget. So that number probably is a little deceptive there on the chart.
Yeah, that's true. And we did recently buy some bonds, and it added yield to the portfolio. Again, the big thing we look at is that duration number at the top of that page, and we don't want that to get too long of the benchmarks. It's just a really good way to, have discipline in the portfolio and not get too greedy with, where we're putting the money.
So we try and target the benchmarks then, more or less?
Yeah.
Okay, yeah.
Yeah. I think his kind of curiosity, Troy, was how do you target the benchmark? And you typically, I'd say in most almost most of the time, you kind of snug up pretty close to that target duration.
Yeah. Yeah, we're not trying to game interest rates, which is a fancy way of saying moving that duration around a lot. We're trying to keep pretty much a neutral approach to interest rate risk.
Right.
For an intermediate portfolio, and then add corporates with better yield if we can find them, and mortgages and things like that to make sure that the portfolio is kicking out the reliable income that it should do.
It's more the mix and the type of bonds versus that duration that I think where they trying to add value.
Gotcha.
Where we add value.
Yeah, that's right, Woody.
Thank you.
Brian, you want to talk about the equity sector allocation?
Yeah, sure. Thanks, Lee. So this page shows there's 11 sectors in the S&P 500, and so you can see those listed on the left side. And your portfolio is there in the middle. And I'll just point out a few things that have helped with performance this year. And historically, or at least for the last 3 years or so, we've had a pretty high weighting in healthcare. And healthcare companies tend to hold up really well when you have market dislocations like we have this year. So if you just think about it, most healthcare companies' businesses aren't really affected by economic slowdown. So that has helped performance. We've also had an overweight in utilities, which has helped as well. And a couple of the companies that we own in discretionary, consumer discretionary, really are kind of more consumer staple like companies, McDonald's and TJ Maxx, which is more of a budget shopping option. So those have all helped performance that we'll see here in a few pages. But any questions on the equity sector allocation?
No.
Brian, you want to pick up on the next page?
Sure. So this shows the cash flow additions and distributions going back to 2008. And you can see the ending fund balance, and this is at the end of 6/30, is $12,054,000. That's up to about 12.3 now. The oil and gas revenue, royalties there, and then the spending policy, it was marked down 25 basis points last year, and you can see the distributions for the capital budget there.
It's interesting to see, well, there's a lot of stuff on here, Ed. You might even want to comment on it, but
I mean, I think what this table demonstrates is that the portfolio is doing exactly as it was designed to do, which is it's providing an ever-increasing amount for capital projects while preserving the purchasing power of the fund for future generations, so that they'll have this resource 20 years from now. It'll be spinning off, way more. And as costs go up, you preserve that ability and increase the ability to fund projects as the portfolio continues to grow.
Yeah, I think that's the way to look at it. The fund started at less than $7 million back in 2008, and it's up to over $12 million today. So doubled in that time span, but that's not taking into account $5.5 million of distributions that have gone out for the benefit of Manistee. And that's exactly what the portfolio is designed to do.
Yeah, and it's kind of interesting. We have a really good parallel with that with the Minger Fund at the Community Foundation. Doug, do you remember how much money that gentleman gave? It was a lot, $10 million or some large number, similar to what we've got here.
I thought it was
15 million, whatever it was, but they manage it the exact same way. It's an endowment. They only take out a certain amount. They invest it the same way, and that they're hoping that will continue to grow and fund more projects, more recreational opportunities. So it's kind of neat that the community has two pretty sizable endowment funds, for the benefit of the citizens.
The next page is probably really the last page we have in the presentation, and this is the performance. And you can see it year to date, pretty bumpy, down 13.6%. And then you can see the trailing periods going back to, it says inception date. That date up there is wrong. I think it's going back further than that. We have a new portfolio accounting system, and so the data on it since inception is a little strange, but I think the important number is that another number to look at here. You can see all these, we talked earlier about the foreign markets, and you can see how these foreign markets, if you look at, let's say, the 5-year period, under the MSCI All Country World, it's all the public companies in the world outside of the U.S. That's a pretty kind of big concept there. But you can see over the last 5 years, the return on that market, all the companies outside of the U.S. is 2.5%, and the S&P was 11.3. If you go back 10 years, it's 3.6 versus 12.9. So pretty anemic returns for the rest of the world. And it speaks to, having 85% of your equities or more over the last 14 years, mostly in the U.S. stock market, has worked to our advantage. And then also at the bottom there, you see this Manistee blend, that's the investment policy statement mix, which is under the footnote. So if you had put the money into the Standard & Poor's 500, 55%, 10% into the rest of the world stocks, 30% into the bond market index, and then 5% into cash, that number came out to, you can see that bottom number. So our returns so far over the last 5 years since we put that all in place has been tracking pretty well against the benchmark.
I have a question. The last economic unadjusted data I saw said we've been decline in GDP for 2 straight quarters, which by normal definitions is a recession. They haven't called that yet, and there was some rumbling that, but this is different. Are we technically in a recession right now?
Well, it's always been my understanding, I was an economics major in college, that going back, that was 100 years ago, that was how you defined a recession. I'm not sure why they're hesitating at this time, except that sometimes there's revised data that might show in one of those 2 quarters, I think at least one of them, it was very modest decline, and it may show if they revise the data that maybe it was not down. Other than that, I'm not sure why they're holding off, but there's a body, it's called NBER, National Bureau of Economic Research, and they're the official arbiter of calling it a recession, and they just haven't called it yet. So I don't know if it's revised data. Troy or Brian, do you know the answer to that? Troy?
They haven't made an official call on it.
Yeah, usually it takes a little while. It's like a delayed 6 months later, they'll say we were in a recession. And I think at this point, there's a lot of people arguing that, how can you be in a recession with such low unemployment? And so, maybe they're tinkering with the definitions. I'm not sure.
Well, that's like raising Babe Ruth's home run total for everything he hit over 370 feet. Didn't make it out of the park, but it's still a home run.
Yeah. Yeah. Or people that were taking steroid injections that got McGuire.
I just curious because I think the general population is feeling like it's kind of a recession, especially with the inflation. And
Yeah.
Yeah.
The last technical recession that we had that NBER called a recession was only 2 months long. It was in March and April of 2020. But that wasn't officially declared a recession until well after we were actually out of the recession, which isn't terribly helpful for people that want to know when you're in recession, but it does tend to be delayed.
Well, I think the unemployment numbers are a little misleading. If you look at the employed numbers, a lot of people have just quit working because we have fewer people employed now than we had in a lot of the 2000s up leading to 2007, 2008, fewer than from about 2010 to 2017, fewer than back in the 80s and 90s as far as number of people working. So it just means they've quit looking.
Yeah. A lot of people dropped out of the workforce
Yeah.
and they don't get counted.
so what does your crystal ball say for the rest of 2022?
Well, that Troy answers that question. I think
And I
Troy's going
think,
to turn over
the
to
Fed
Brian.
is going to continue to push rates up slowly, maybe not as aggressive as they've done the last couple times. I think there's already a drumbeat that maybe they don't need to do another 75, that they should drop that back to 50 basis points when they meet in September. I think there's also a pretty much foregone conclusion that the Fed will continue to raise rates, maybe just not as aggressively for the rest of the year. And the bond market is reading that as they're going to eventually slow the economy and take some wind out of the sails. And so that's why longer-term interest rates have stopped going up as much. And they've even come down a bit over the last couple months. So on the bond side of things, I think, we could see, a little bluer sky in the second half of 2022. But I think, on the equity side, it's hard to say. And I'll let Woody and Brian comment there. There's just probably a relief that the Fed doesn't have to do such an aggressive amount of hiking. At least most recently, that seems to have helped the temperature in the equity market as well.
Yeah, I'll just add to that. I think that's why we've seen the equities perform so well over the last 6 weeks. Is we've started to have more clarity on what the Fed policy response will be. And if you think back to May, we didn't know if it was going to be 75 or 100. So now that we've had both of those large increases behind us, and then we had this pretty positive inflation reading this week, I think that's kind of that tells you how the market would react if inflation continues to improve.
Ed, one thing we've learned is we don't do market timing.
They don't have the magic 8 ball.
Forecasting. However, I think, the other issue that companies are starting to struggle with, you see Walmart, their announcement last week, is that demand is softening and costs are going up, labor costs are going up, financing costs are going up, because where big companies were borrowing at 1%, now they're borrowing at 3 or maybe 4. That's expensive, and of course we all know labor costs are going up significantly to get people to go to work, to reflect inflationary pressures, and companies are having a hard time raising prices in the face of softening demand. So it kind of looks questionable as to the direction of corporate profits for a while. And we've learned over time that stocks follow profits, and the stock market will follow the direction of corporate profits. And then there's also the forecasting period that stocks are usually performing how they expect the economy to perform in 6 to 12 months. So whatever the stock market's doing today, it's reflecting what it thinks will be happening 9 months from now. So it could be, if the stock market keeps going up, it thinks that we could have some softening, some slowdown, but maybe by next summer, by next spring, let's say next spring, things are looking better again. So, there's just so many of these imponderables that's why Jeff's nodding, because these are almost impossible things to do. And you realize if you've tried it a few times, it's a risky business.
This is a little bit off the wall, but with the inflation rate as high as it's been, cost of goods and everything, how can you offer an opinion on what it's going to do to Social Security allocation?
Yeah, well, the rates for July and August and September, it's the next increase of Social Security will be based on those 3 months. And I think they do something with annualizing that number. It's very likely that the next increase is going to be something at least 6%, maybe 7%, maybe 8%. But it's unlikely that it's going to be under 6 or 7. But I think it's somewhere. I just read an article a couple days ago in the Wall Street Journal about projecting this number to be in this
Be meaningful.
6 to 8 range. Is that what you've seen?
Yeah, it should be meaningful. At least what it was last year. Better.
And not only that, but the retirees are finally starting to earn a little, well, if the banks raise their rates, which they always lag, but if they're in any kind of money market investments, they're actually going to start earning some interest income, which is good for retirees as well.
Absolutely.
Yeah, that's a good point, Ed, because retirees for over 10 years have really been under a lot of pressure. You had very modest increases in Social Security, something on the order of 1 or 2% a year. Plus, if you were investing your money safely in CDs, you were getting maybe 1% on CDs. Well, now all of a sudden you're getting maybe 3 or more on CDs, and you're getting these huge bumps in Social Security. So retirees, it's kind of the revenge of the retirees. They're finally getting their due.
Well, that would be good. Especially in this town.
Yeah.
So,
We, like mine at 70, let it bump another 8% plus the inflation rate.
Yeah.
Now, I remember back late 70s, early 80s when CDs just came out with a 6-month, $10,000 minimum. And a couple guys, Pete Larson, who was at the bank and since deceased, he was going to retire because he figured he had enough savings, getting 10% return on his money was great. And I know some of the people here remember a guy named Don Bilski. And Don was pretty opinionated and pretty cheap and pretty shrewd with his money. And when I was at the bank, he called me up from Florida and said, Doug, will you match the rate down here? And I said, well, what is it? This would have been the 87, 88 time frame. He goes, it's 18 3/4 for 6 months. I said, Don, there's nobody in hell paying that type of money. Yes, there is. No, they're not. About 3 days later, I get an envelope, a manila envelope with a wadded up sheet of paper from a page of a paper. He ripped the paper, wadded it up, put it in the envelope. It was Broward County Savings and Loan. He was paying 18 3/4 for 6 months money. And
Wow.
which, if you look back at history, is pretty much what led to the savings and loan catastrophe because they were financing 20 and 30-year loans with 6 months money.
Yeah.
Because I know when we were making mortgages at the time, we were 3-year balloons at 16 3/4 and losing money every day doing it.
Yeah. Well, Doug, it's interesting you mentioned that because Troy alluded to that was the last time we had inflation out of control. And the Federal Reserve learned that the way to control inflation when it's out of control is just to kind of stamp it out, slam on the brakes, raise interest rates, shut down the economy, and you know what? That inflation's going to go away. And they learned from that, and that's what, because once it gets built into people's belief system that we're going to have inflation, it's kind of hard to stop it. They want a wage increase, and then there's other wage increases, and then companies have to raise prices, and it's a vicious circle. And so they're really trying to play that game that they learned from Paul Volcker, who was the Federal Reserve Chairman in the early 80s. But speaking of these yields in retirees, as Jeff would tell you, there's, if you have $10,000 to invest and you want a good return, is to buy these I bonds. They're savings bonds referred to as I bonds, and they pay 8 or 9%. They're government backed savings bonds that are currently paying 8 or 9%, at least for the next 6 months. And you have to hold them for a few years, but it's kind of like when you mentioned those CDs back then, this is kind of the equivalent good deal today. Right, Jeff?
Yeah. So there's a quick funny story. Well, I don't know if it's funny, but it's just interesting. So there's a colleague of mine down in Grand Haven, Tom, and Tom started with Edward Jones back in 1977. And in 1981, he tells this story to us about how CD rates were in the 18 and 20% range, and he was trying to sell U.S. government 30-year treasuries, which were only yielding, I don't remember what he said, 15 or 16% at the time, right? So they were yielding less. So he's like, I couldn't get anyone to buy it, but he goes, I got a handful of people to buy a 30-year treasury. And what he said was, by the time they got into the 90s, they were thanking him. And when they finally matured in whatever it was, 2010 or 2011, he's like, they were literally crying, like, where do we get this at again? Because, I mean, they were yielding 15% the whole 30-year, right?
Yeah, so, and there were zero coupon bonds that, I think Troy could correct me, but a 30-year bond you could buy for 4 cents on the dollar.
Yeah.
And then at maturity, it would be worth $1.
Right.
is that like tiger bonds?
Yeah,
Because I
yeah.
bought a bunch of, well, not a bunch, but I bought enough of them when my daughter was in grade school. So that helped finance my portion of her going to U of M significantly. So I was very lucky because I wouldn't have dreamed of doing that except my parents had advised me that
That
this
was the
would be-
smartest thing to do. The CDs, 6 months later, heck, you were down to 12, and then a year later, it was down to 5. And
Right.
We had Bob Blakesley, who was at the bank. When Bob retired, we had a lump sum that you could take a lump sum retirement. And we bought a bunch for him. My dad said, Bob, why don't we buy government and let's buy 20-year. You'll get a payment every 6 months. You get it. So we bought, 6 issues. So every month he got a check, and his yield was about 11 or 12% at the time.
Yeah.
And he was just really thankful to put that retirement in. But like with you, the Tiger bonds, when each of my dad's grandkids were born, he bought 0 coupon bonds that matured, and they were 18-year bonds, so they were already in the market. But he wanted to mature when they graduated from high school. So each kid had a lump sum when it came time to go to college.
Yeah.
And it really had helped a ton. For like my son in Grand Valley, it basically paid for it.
wow.
And it was nice
Yeah.
to have some of the forethought. So. Everybody can make money as long as it stays steady.
Right, that's right. Well, this has been very interesting. Um, Does anybody else have anything they want to talk about before we adjourn? I really want to thank you for coming in person. It's really very helpful to see somebody face to face rather than on Zoom or,
Yeah.
it's just a welcome change, so we appreciate that.
Thrilled to be here.
Yeah, so, all right, I will take, there's no public available, so I won't ask for public comment. I'll take a motion to adjourn.
I'll make that motion.
Or
So what do you do with the rest of your time now, Woody?
holes in the water.
Well, I've got, just like you, I got emails and
Understood.
reading material and calls and
It's gonna be out on the deck.